Welcome everyone to Vested Interest. This is Shane back for a stock pick of the day video. Today we're going to take a look at Eli Lilly out of the healthcare sector. Before we get too far into the video, if you can do me a big favor, hit all of the buttons down below. You know what to do down there. That thumbs up. Make sure you're subscribed. Join us on this journey to financial freedom. Join the Vested Interest community. Click that notification bell so you're notified whenever I put out any new content. Make sure you drop a comment. Let me know what you think of the video. Let me know what you think of Eli Lilly. And for those of you who are subscribers and viewers of the channel, I really do appreciate it. The channel continues to grow because of people like you. Watch time is one of the metrics that the YouTube algorithm looks at. So if you could watch the videos to the end, I would really appreciate it. And share with anyone you think might find value in the content as well. Now, this is the Vested Interest stock screener. This is the criteria we will be going through in the video. Just the top 8 here. We won't add in price to book. This is what is added in whenever we look at financial companies like banks or insurance companies, and then it would have to meet 6 of 9. And if it does make it onto my watch list, that does not necessarily mean I'm adding it to my portfolio. It just means out of the thousands of companies out there, it is one I am interested in doing more of a deep dive into the financials of the company, doing a discounted cash flow analysis, figuring out a range that I'm willing to pay for it, and then possibly adding it in the future. A lot of stocks go onto my watch list and then fall off in the future as well. All right, check them out at their homepage, www.lilly.com. That's www.lilly.com. Again, this is a company out of the healthcare sector. We're a medicine company, and that is really what they are. They're a lot like a Pfizer or a Johnson & Johnson or a Bristol Myers Squibb, right? They're making the pharmaceuticals that we are using, people are using. So I'll just read the rest of this. Harnessing the power of biotechnology, chemistry, and genetic medicine, our scientists are urgently advancing science to solve some of the world's most significant health challenges. It all started nearly 150 years ago. Yep, that's right. They've been around 150 years with a clear vision from founder Colonel Eli Lilly. Take what you find here and make it better and better. You can read the rest of that. You can go check out their homepage, what they have in clinical trials. That is important for healthcare companies. You want to be looking at not only what they have out right now, but also what they have coming up in the futures. These drugs, pharmaceuticals, only have a certain time where the company that created them has a patent, and then after that, then the cheaper versions of those drugs can come online. You know, anyone can make them once that patent has expired. So it is important to not only look at what they have now, but also what they have in the pipeline coming up in the future. Now, the reason we are taking a look at them, down 5.59% on the day, we are talking about Eli Lilly and Company, ticker LLY, again out of the healthcare sector, closed out the day at $762.95, 52-week range as low as $677.09, as high as $972.53. And believe it or not, they are actually within 15% of a 52-week low, $778 and some change or lower is where they need to be. So they're just under 15% of a 52-week low and closer to their 52-week low than their 52-week high. Market cap of $684.928 billion. A beta of 0.4, so they are less volatile than the overall market. And if you're wondering why I look at beta, for the most part, I want my overall portfolio to be less volatile than the overall market. So I want to gravitate towards companies that are less volatile than the market. Then I will not have wild swings in my portfolio or in the positions that I hold. Now, the market's been pretty crazy over the last couple of years, so I've seen wild swings anyway. But the idea is to focus on low beta companies with high growth that pay a dividend, in my case, so that your portfolio doesn't see those large swings. That's why I look at beta. And one is the volatility of the market. PE ratio, price earnings, seems very, very high at $62.58. Earnings per share, EPS, at $12.28. Earnings date coming up August 7th, so we'll see that. Is that next week? I believe that's next week. So if you're interested in this company, I would urge you or suggest you go look at the earnings report that comes out. Forward dividend is $6. You can divide by 4 or wait. We'll see it towards the end of the video what they pay per share per quarter. But their yield is relatively low at 0.74%, at least if you were to buy them now. Ex-dividend date, August 15th. Looks like they're going to pay out on September 10th. So if you were to buy them now, you're in front of that ex-dividend date, but you want to buy them August 14th or before to get that next dividend. 1-year target estimate, at least according to Yahoo Finance, $962.70. $9 and some change off of their 52-week high, so not quite getting back up, but they do see some upside at least Yahoo Finance, where I pull this information from. I am not affiliated with Yahoo Finance, just one of the sources I go to for information. They estimate it going back up close to its 52-week high. Now, jumping over to the right, I like to look at dividend yield theory as a quick check to see if the company is potentially undervalued. Again, it is not the end-all be-all, but it doesn't take any math, so it is a easy way to look and see if, based on dividend yield theory, and the theory is that a company will return to its mean, whether it's overvalued or undervalued, it will return to its average dividend yield. So 5-year dividend yield average is what you look at, 1.10%. You compare that to forward annual dividend, 0.74, over here 0.74, same number. Now, since it is lower than their 5-year average, that actually speaks to overvaluation, right? They're inversely correlated. So if this was higher than their 5-year average, that would be potentially undervalued. Since it is lower, it's potentially overvalued, at least according to dividend yield theory. Payout ratio is low, though. I like under 75% here. They're at 43.94. So gives them a lot of room to increase that dividend. Doesn't look like it's in danger of a dividend cut. Now, I also want growing free cash flow over time. A company can do some things with that free cash flow. They can pay down debt, make acquisitions, reinvest back into the company, carry some of that cash on the balance sheet as cash in case they have some downturns or a rainy day. Buy back shares, pay a dividend, which this company does, and raise that dividend over time. We want a company to be able to do all of that, so we want growing free cash flow. Now, going back to December 2022, you can see here $4.6 billion in free cash flow. Big downturn in 2023, 3.15. 2024 saw a further downturn, though. We'll talk about repurchase of shares. Some of that might have been because of the repurchase of shares. Free cash flow in the trailing 12 months, negative $1.2 billion. So not good. Looks like actually over, again, maybe not in 2024, but this year possibly. But keep in mind, we're in July, so we do have some time left in the rest of the year to see it come back. But I don't know. That's a big negative right there. Repurchase of shares. They are pulling shares out of the market. 2022, 1.5 billion. 2023 dropped that to 750 million. Now, this is why I said possibly in 2024 you'd have to do the numbers and see what the shares were worth at the time. But 2.5 billion in shares pulled out of the market. That's a huge jump, right? Even above what they did in 2022. Trailing 12 months looks like they're continuing that trend, 3.7. So that 2024 repurchase of shares might contributed to some of this downturn. I don't think it contributed to all of it. So it does look like from 2023 negative free cash flow. We don't want that. We'd rather see it growing, not decreasing. All right, jumping over to stockanalysis.com, another source that I go to for information. I'm not affiliated with stockanalysis.com or Yahoo Finance or any other source. Just a couple of sources, and I do recommend 2, if not 3 sources, so you can make sure the information you are looking at is accurate and up to date. Now, they have 17 analysts that have taken a look at this. They call it a strong buy. Low estimate of $700. So if it dropped down to their lowest estimate, that would be a 8.74% decrease from where it currently sits. Average estimate of 1,016, a little higher than what we saw with Yahoo Finance on the previous page, but not too far off, and that would be a potential 32.42% increase. And if it happened to hit their high estimate of 1,190, that would represent a potential 55.15% increase from where it currently sits. And you could collect that under 1% dividend along the way. Now, jumping into the statistics, I like to look at return on capital employed to see how well the company is reinvesting its capital back into itself. And I like 10% or better here, and they are smoking high, 34.01%. Very nice return on capital employed. They did not have anything listed for forecasted EPS growth. I like 5% or better forecasted over the next 5 years. Revenue growth, they didn't list anything either. Quarterly payer, as we mentioned, low payout ratio, again, 47.19%. I think that's a little higher than what Yahoo Finance had it, but still in the 40% range. Dividend growth, very fast dividend growth, and they'd have such a low dividend yield. I would hope they would have fast dividend growth, 15.31%. With the low payout ratio, it's nice to see that growth in years, 10 years. Buyback yield is positive at 0.02%. That means they are efficiently and effectively pulling more shares out of the market than they are issuing. You want buyback yield to be positive. If it's negative, that means they are issuing more shares than they are pulling out of the market. And you'll see that a lot with REITs, business development companies, those type of holdings. Shareholder yield is positive at 0.79%. Now, they do pay out a typical timeline that most companies do, March, June, September, December. Going back February 2023, 113 in dividends paid. It looks like February 2024, $1.30, raised it up there. Looks like February 2025 up to $1.50. So I would anticipate if they're going to maintain this trend, it will be February of 2026 before we see that next dividend raise. All right, let's run this one through the screener as we wrap up here. Understand the business. Yes, Eli Lilly is very similar. It's a pharmaceutical company, very similar like a Pfizer or Bristol Myers Squibb, in that vein of companies. Growing free cash flow. No, we've had at least a couple of years of downturn. Growing dividend. Yes, dividend payout ratio is under 75%, so check there. Dividend yield theory says they're potentially overvalued, so no check there. It is within 15% of the 52-week low, believe it or not. Return on capital employed is above 10%, over 30%, very high, very nice. They did not have anything listed for earnings per share growth, so can't give them anything there. But 1, 2, 3, 4, 5, they do make it onto my watch list just barely. I would like a bit more of a pullback on this one. I know it's expensive per share, but the healthcare sector in general seems to be really pulled back right now. It might be time to look at that sector overall and find some companies, if you're looking for something in the healthcare sector, and find some companies you're interested in. Certainly, this one could be one of them. At least it makes it onto my watch list. Let me know what you think of Eli Lilly in the comment section down below. Is it one you're buying? Is it one you're holding? Is it one you're selling? Maybe you're part of the reason for the downturn today. If so, would love to hear from you. Let me know what you think of Eli Lilly in the comments down below. All right, that is it for this one. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. Drop a comment down below. Let me know what you think of the video. I do personally read and respond to the comments. I am always interested to read your questions, opinions, or suggestions for future topics. If you have a company like Eli Lilly you'd like me to cover in the Stock Pick of the Day series, drop it in the comments. I'll try to work it in the rotation on a day it pulls back. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great week, and we will see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investor journey for educational and entertainment purposes. Investing involves risk. You can lose money. You should never invest any amount you are not comfortable losing. Always do your own research. Invest based on your situation and circumstances and select criteria, or seek the advice of counsel by a certified financial advisor. For those of you who made it to the end, really do appreciate you watching to the end. Don't forget to hit subscribe if you haven't done so. Like the video, share the videos, drop a comment, and we'll see you in the next one.